Welcome everyone to our FSC mid-year financial cycles summit event, day 3 of June 25, 26, 27. Your host today, as all the days so far, Ron William, FSC Development Director. Always an honor and a pleasure to help host and contribute at these FSC events. As always, we continue to break records in terms of the awareness on cycles and continued registration for these events and membership increases. Highest ever record signups for this particular event, continuing that onwards and upwards trend. Thank you for signing up and attending. Thousands of registrations for this FSC mid-year financial cycle summit. Of course, market movements does help in the sense of inviting us to reevaluate which direction both the trends and the cycles may be switching to. We have already had 4 fantastic speakers present their key insights, with the following grand finale too for this day 3. Now, as always, we have a tradition here at the FSC of warming up the audience as part of this like-minded passion for markets and cycles. And in doing that, as part of the virtual routine, we'd like to encourage you all to share, connect, and click on the mouse with a few kickoff questions. Firstly, where in the world are you from? Especially if for some of you who are attending day 3 or maybe not all together. So where in the world are you from? Previously, we had many different states within the US, Europe, UK, and I also recall seeing some areas in the Middle East and Asia on a late night shift. Second to that, market cycle views. What do you think about all the cross assets, risk on, risk off, late cycle, further upside ahead, or are you hedging on the downside? We've had a real mixed perspective here based on markets that were covered, but also different approaches and different cycle and timing frameworks. And then just lastly, given that this is the follow-up session and the grand finale day 3, what have been your key insights specifically from the prior session? And I'll give you a quick heads up in terms of key insights I took on board from guest speaker FSC board member Lars von Thienen, who spoke about the duration of the current Bitcoin bull cycle. How much longer will the good times last? Key insights on my mind were the latest signal on his well-known 200-day cycle that has been presented on before. Then the dynamic timing, which was something new that, for everyone in terms of how to combine different timing data sources, such as the FSC model, digital signaling, as well as seasonality and Bitcoin halving data. So there was really interesting non-correlation confluence of all 3. And then right at the end, of course, the second part of the $1 billion question, which we look forward to sharing a check on for Lars being correct on this call. Fast forward into here and now, what next for Bitcoin, the potential top into Q2 2025 for those of you looking for that next setup. So out of those key insights and maybe others that were included, what did you find interesting on that session? And then the following one, Dr. Richard Smith, our FSC chairman, who focused on short-term cycles in US equities. Remember, short-term cycles is the new addition to our cycles software available to all members. And also we have a cycles TV special to complement the previous weekly one. The focus there in Dr. Richard Smith's presentation was trading beliefs, his approach, short-term cycles, and then to follow a focus on US equity setups and this non-confirmation that is taking place between some of the tech-centric indices and more broad-based ones. And then finally, what I found very useful, and I think we got some broad positive feedback on as well, additional strategies as well as trend and cycles, but more focusing on risk management and diversification using much of his proprietary framework. So if you could share in the chat which one or many of these different insights were top of mind for you, it'd be wonderful to pulse check and to know the impact that all of this work is creating for everyone. Now, as a roll up for the session ahead, our speakers for today. And just before I dive in, I want to just double check the chat and see where everyone is from. We have Ernie from Seattle, Washington, Bruno from Geneva, big shout out, Swell from Raleigh, Elliot from Munich, Germany. So we have US and Europe there. DR Barton, greeting everyone else, but he's also a team member based in the US. So for those of you who have shared, thank you. Anyone else, please click on the mouse and share a little bit more insights about where you're from, market views, and then key insights from the sessions that I just highlighted. Now for our session today, we have Bill Sarubbi, FSC board member, focusing on US stocks 2024 into 2025. And then to follow a little bit earlier, ahead of the next hour, Andy Pancholi, also on the team, focusing on the power of roadmaps. There are no black swans. Just to re-clarify, any questions continue to share on the YouTube chat, as you already have been doing over the last few days. Please do so, especially in the last 15 minutes of the presentation, where we start to collect these questions to prepare for that engagement. And now to welcome our session 5 of 6 in this 3-day FSC mid-year conference. Bill Sarubbi, focusing on US stocks 2024 into 2025. Bill Sarubbi is a regular Forbes contributor. Sarubbi operates his own money management and consulting services. He was an analyst, institutional broker, and technical strategist on Wall Street, a technology fund manager, North American strategist, and member of the currency hedging committee with the Abu Dhabi Investment Authority. Bill,
yes,
pleasure to invite you back on, and
thank you,
looking
Ron.
forward to your insights.
Okay, this is US stocks 2024 into 2025. And as I always say, a reasonable probability is the only certainty. So I try to come up with percentages that put the odds in the investor's favor. Now, the big question is, I think we're all wondering, when will the deteriorating fundamental conditions bring the stock market down? And when I say that, I mean, if you going to New York tonight, I hope I'll come back alive, and I hope the car will make it. It's I think we see the deteriorating social conditions all around us, sky high real estate prices and rising interest rates, just like the 70s. So we survived that, we'll survive this too. But it's more likely that the stock market will recognize us later in the decade than in 2024. In 2024, I really, except for September, I don't see a meaningful correction between now and the end of the year. Most years using the decennial pattern, years ending in 7 tend to be very difficult. Years ending in 0 tend to bring the market down. Most bear market lows occur in years ending in 2. We're in the middle of that. We're really not in any space where crashes occur. And as far as the panic cycle goes, most panics occur in October or November of years ending in 7 or 8, and we're not close to that. So, but one of the symptoms I keep my eye on is the auction market. Too much money is lifting all asset classes, like they said in New York in the 1980s. Too much cocaine is nature's way of telling you have too much money. Well, high auction prices, and here we are. Here's a John Lennon, You've Got to Hide Your Love Away, acoustic guitar, sold for almost $3 million. That's a sign that there is too much money. Here's another one. Here is a 2015 Lamborghini. They only made 9. This is in Dubai. And it went for $6 million, which is the highest ever price for a car in an online only auction. Well, Dubai, that does not surprise me. It's my former home. So how does this occur? Well, in June 1980, I'm surprised that people don't take greater note of this. In June of 80, Jimmy Carter signed the Monetary Control Act, which says that the Fed can monetize anything, which means they can take any asset. They could take our collective credit card debt and they could purchase it from us, give us fresh cash in our bank account, and they will hold our credit card debt as an asset on their balance sheet. And there's no limit to that now. There's no link to gold. There's no limit to anything. And we still have a flood of COVID money, and I predict there'll be more money. And I said, this will probably end when camels learn to fly. And my Abu Dhabi audience said that they assured me that they would see a sky filled with camels before governments stop spending and stop inflating the currency. So some of that money spills over into every different market. I mean, the art market I know because I just went to an art show. It's going everywhere. But 2024 has been playing out as expected for the most part. Let's look at this histogram. This is all years ending in 4 were in 2024, but also have been election years. And as you can see, the number is small, 7 down to 6. So June was up. We're in June right now. So I think we were in June. We're going into July. The rest of the year looks okay to me, except maybe for September and October, which is there's usually a correction. The only question is to the magnitude. So from this standpoint of the 4-year cycle and the 10-year cycle is expressed as a histogram, the worst is behind us. And the S&P is up about 15% in 2024. When the S&P has been up at least 10% at this point in any year, which means I ran this last week, so let's just say through June. Here is the month-by-month performance in the remainder of the year. 1 month later, so 1 month later would be July. Then 2 months later would be August, September, October, November, December. And as you can see, the market was up about 2/3 of the time in 37 cases. Now, this is from 1928. So this is what I call momentum analysis. And that's what's been keeping this market going. Look at a trailing 90 days. Look at the month of January. The only spoiler here was that April was down. If January and April are both up, you have very high odds of a higher market at the end of the year. And as I said, we're not in any rough patch in the decennial pattern. So now here's the old 1, 4, and 10-year cycles. So just for those of you who are new, the 1-year cycle is in red, and that is the seasonal cycle of the year. It hardly changes. And this is the Dow Jones going back to 1885. So it's not a short price history. But here is the usual summer rally. You see June here, July. You see the summer rally, then the dreadful September, October bear, and then a strong fourth quarter rally. That's the annual cycle of the year. It has been tested in the Financial Analyst Journal, the home for all the PhDs. No technicians or cycle theorists are allowed. And they cannot explain it, but they verify it's real, not only in the US, but in foreign markets. The 4-year cycle, which is called the election year cycle, because supposedly the Federal Reserve pumps up the money supply so that the president looks good in the election year. And as Ian Notley of the Notley Information Service used to point out, that's a good argument, but this cycle existed before the establishment of the Federal Reserve in 1913. It exists in countries where there's a 4-year election cycle, a 6-year election cycle, or no elections whatsoever. In other words, there's a 4-year cycle, which is about 3.8 years long. And then there is this green line, the 10-year cycle, which I've mentioned. That is the decennial pattern discovered by Edgar Lawrence Smith of Ameritrust Bank. And here I put them all together. So as you can see, we are about here in June, and this cycle runs straight up into early September. And when you run these analyses, September into October will always look bearish, unless you eliminate that one dreadful crash in 1929, because that, if you eliminate that, you get really a more accurate picture. In other words, one outlier is distorting the cycle to the downside. It's really not that bad in most years. So this is the monthly cycle. This is the cycle only in Q3 to give you a better look at it. And the average high in any year is September 5, according to Colby's Encyclopedia of Technical Analysis. And since Bob published that book, I forget how many years it was, 10, 20 years ago, what has happened is he noted the average high is September 25. The average low is October 27, which was exactly the low, I believe, last autumn. If you could have, from 1915 up till the time he wrote the book, which was sometime about 20 years ago, if you could have shorted the market, you would outperform by 3,000% just by shorting from September 5 to October 27. For some reason, there's a general tendency for the market to decline at that time of the year. So not surprising that that shows up. And here's the 2024 monthly histogram for years ending in 4. This is years ending in 4 only. The blue line being the, well, let me start with red. It's the probability of a rise that should read in that month. So in other words, there's a 75% chance of a rise in November, again in June, which is the month we're in, and again in January. The blue line is the percentage change. The green line is the expected return. It's the product of the numbers represented by the red and the blue line. So right now we're in here, years ending in 4. July has not been very kind. But here is the election years only. Now you'll note that July here, there have been only 13 of these years ending in 4. There have been 34 years which are election years. And you'll notice this period from May through August has been very strong, a little bit of weakness in September, October, and again, a strong close to the year. So this weakness in July is somewhat wiped out by or offset by the election year in which July has been strong. So here right now is the daily S&P, and I think we're going up to about 5,600 here because I'm taking this rectangle and I'm simply projecting it straight up to get a price target. And I think that the support line is probably right around here at 53.50 or so. That's where I think we are right at the moment. And 10-day advances less declines. Advances less declines on a 10-day moving average basis. You'll note the divergence between here and here. I think leadership is simply switching. It is going, there's money flowing out of stocks like NVIDIA and flowing into stocks like Goldman Sachs. We'll look at stocks later. Here's the average Dow Jones performance in the month of July. 3 viewpoints based upon Dow data from 1885. All months up 64% for an average 1.3 gain. In an election year, it's up 60.3%, not very different, for an average change of 0.9%. Years ending in 4, up only 38.5% for a 2.6% loss. So there's something about July and years ending in 4. I don't think it's going to be that big a deal this July, but we'll see. It could just be a correction, and the market may finish July higher than when it began. Now here's the S&P in July. This is the expected return from about 1928, and you'll note the market tends to be strong. This could be the 4th of July holiday bias that Arthur Merrill wrote about in his book, Behavior of Prices on Wall Street, and then you hit a high around the 17th to the 24th. So if you're looking for the next correction, it's in this time period. So what would you look for? Well, first of all, if the market is overbought here, this confirms the histogram. And if it's oversold here, that confirms the low. That's the way you confirm cycle projections with live at the moment technical indicators and oscillators. Here's the NASDAQ 100, and we have hit the, now I'm very aware of this because I was a technology fund manager. The actual numbers are technology usually tops around mid-August and bottoms around mid-October. And it doesn't show up right here. This is the NASDAQ, which of course it's 34 years, and of course it is heavily laden with technology. So if you want to take profits in late July, I wouldn't advise against that. I would certainly, history does confirm that notion. And here's the sector rank at the moment. So let me explain. These are the sectors. That's industrials, finance, technology, real estate. And this is the seasonal rank. So this is the rank for next month, July, and RSV is a special measure of relative strength. So in other words, XLI industrials in the month of July have been the 3rd strongest of these sectors. And right now its relative strength is 3. XLE, its energy is number 1, which I would not pay a lot of attention to. XLK, that's the technology, seasonal rank 5, relative strength rank 4. But I look at the top ones down here, basic materials, utilities, healthcare. I wouldn't look at those. I would underweight them. Now here is the S&P 100 screen. It is the same screen, but for stocks. And this is where I've begun to do my stock picking. You'll notice for seasonal rank for next month in the S&P 100, and let me just tell you that these screens show that the strongest markets or strongest indices are the S&P 100, Barra Growth, the NASDAQ 100, and the NASDAQ Comp. It's all big cap and it's all technology, which we already know. But there are a few. I'm looking to move into stocks like Costco, which I've already done, I already owned it. Qualcomm, which is more communication. Amazon, which I didn't own, but I'm going to add. Goldman Sachs, General Dynamics. They show up at the top. Already own Walmart, already own HPQ, which is Hewlett Packard. And you can see Apple has come up in the rankings. It's really not up, but I do own a small amount of that. So these are the heaviest weights. That's the S&P 100. Let's go one further. Here's the S&P 500, same type of screen. And here we have Marathon Oil up number one, which is a bit surprising. Cuervo, Optiva, and let me see. Well, there's Domino Pizza. Don't ask me how it got up there. And here's Google again. Now, this is what I like. Here's Google number one, and here's Google in a 500 stock index. It's around number 10. And I give more weighting to the RSV, which is the relative strength rack. So it's saying EQR is the second strongest stock in the entire S&P 500. Down here, we have Meta, and we see Yum Brands, which owns Pepsi-Cola and I think Kentucky Fried Chicken. And here we see, we've already seen Google, but you'll notice it's not heavily dominated by technology. So I'm doing the stock picking from this list, looking for non-tech stocks to offset some of the risk that is inherent in holding mostly technology. Now, here are the weak stocks. This is the other end of the spectrum. EL is Estee Lauder. Uber looks like a good short to me. I may seriously put on that. It's Autodesk, Ford, General Motors, GE, Deere. You note the old GE, GM, and Deere, the old stocks, the old big cap stocks, not highly rated. Estee Lauder, I don't know what the weakness is in the cosmetic stock, unless ladies don't want to look pretty anymore. Uber, you know what Uber is. I think they're facing challenges according to the screen. And we can go on down to Ross Stores, Garmin, Tyler Technologies, CVX. This is Chevron Texaco. So this is where I would seek some shorts. So this is what I have come up with. At this moment, I am seriously adding these stocks between here and Monday. Grindr, which I already own. In case you don't know Grindr, don't worry. Few people do. It is a dating website for the LGBTQ plus, I hope I didn't leave anybody out, community. It's a growing community. The stock I bought at 8. It jumped yesterday, Thursday. I think it jumped 10% yesterday. But it is up to 10 or 11 right now. I look for it to go higher. Google, which I'm going to add, I already mentioned Google. We all know what Google is. GS is Goldman Sachs in the financial sector. Oracle, which we know, the software stock. HPQ, the old Hewlett Packard. Apple, of course, we know. Costco and Qualcomm. Short, I like ADSK, Autodesk, WBA, Walgreen Boots. I think they're going to go right through zero and go into negative territory in the charts. But today, that stock reported earnings. I was short, and it was down 25%. I expected to go lower. It looks to me like they're going to go into bankruptcy. Ford and Uber. And this is a work in progress. I'll be adding stocks over the next week to get set for Q number 3. Now, here is Grindr. And you'll note right in here, the biggest shareholder dumped some stock. But the problem with insider buying and selling, you don't know why he sold it. He may want to buy a new house. He may have had to make bail. I don't know. He bought the Lamborghini we just saw with the Lennon guitar. And then you'll note the pop up here, and this is the big pop yesterday. So this is the daily chart. It looks like it's going a lot higher to me. And note the relative strength broke a downtrend line here. So again, this is, once you get a platform like this set up, you only have to pay the maintenance fees. I'm involved in another business which ports or streams out classical music, ballet, and dance. We've got those costs covered. As long as those costs are covered, if you get more subscribers, it goes right to the bottom line. So, and you'll note, this is the Grindr monthly cycle. And notice it just hit a low as it popped up. I think the cycle popped up 2 days ago, and the stock popped yesterday and again today. So that's putting it all together. Now, all years ending in 5 that all have also been post-election years. Now we're going to next year, 2025, in a post-election year. Years ending in 5 have been the strongest in the decennial pattern. Years after the election have been the weakest in the 4-year election pattern. So this is what it looks like. If you put the two of them together, again, there've only been 6. It looks like a strong January, February, a weak March, and a weak June. And September doesn't even look weak here. Look at this. From the middle of the year, this is starting 1 year from now, looks very strong. So 2025 sets up a conflict. Years after the election cycle have been the weakest in the 4-year election cycle, but years ending in 5 have also been the strongest in the decennial cycle. There have been 6 such years since 1885. 5 of 6 have closed substantially higher. 1 was down slightly. The average was a 33% gain. So is the post-election year next year a concern? Not according to this. And let's go back. Maybe in the first half, you would see weakness. Maybe you'll see a Q2 sell-off, maybe March, April, June. But after that, it looks like it's going straight up. So that is what the initial outlook is for 2025. Now, here's the 1-4 10-year cycle for next year. And you will note it's about the same as this. It's expressed differently. And there's the old September swoon down into October. Again, the annual high, September 5, the annual low, October 27 in any year. But here you get a nice January, but then you get a leveling off and a low in late March, a rally in April, then a decline into June, and then a rally up into late August. So I don't see any crash here either. Again, it's years ending in 7 or 8, and especially years ending in 0 that usually bring the big down markets. Now let's switch over to the US 10-year note. Here is the average for any year. This is 42 years worth of data. Again, the red is the probability of a rise on that day, which is in that month, 66% of the time. Where are we right now? We're just entering into, or we're just leaving June and going into, what's this? July, August. These are the 2 strongest months for notes. I'm not going to argue with that. I closed out short positions with a small profit and went long. These positions are about flat. But then again, June is a relatively flat month. The notes in June are only up 40% of the time, but it's 60 to 65 in July and August. So one thing this graph tells us is if you are short notes here, you are walking up the down escalator and you are trying to eat soup with a fork. This is no way to make money. So if you have any position, it should be long. So again, you see the value of the cycles. And this is the note. Now, this is the average month in any year, which is the solar cycle. The calendar comes from the relationship of the Earth and the Sun. So it's a calendar year or a solar cycle, which is not circular, but an ellipse. That's the average. The dynamic cycle is extracted by sine wave analysis directly from the most recent data, going back to 1983. And as you can see, it rises. It rises right through July and August. So if this is pointing up and this is pointing up, these percentages are not 60 to 65. They're more like 70 to 75 or 70 to 80, because the dynamic cycle is usually always stronger than the monthly cycle. The annual cycle occurs every year. This cycle comes about by whatever cycles that the system finds are strong and puts them together and projects them out. So I am long the notes, the 10-year note in the US. The other markets, the 30-year bond, the JGB, and the Bund are slightly different, but they tend to follow the US market. The Bund is, I think, already bottomed. Oil seasonality, again, a very seasonal market. This is the expected return only. This is 41 years worth of data. This is the likelihood that the price is going to go up or down multiplied by the magnitude of the move. And you can see you're very definitely in the down, you're going down the down escalator here. And we're currently in June, and oil is up somewhat at the moment, but you're in the weak part of the year. And here's the relative strength of the oil stocks. Now, this is the relative strength measure only, and the benchmark is the XLE. So these stocks that are north of 97.5 are the only ones. Yes, I know Cameco is the uranium stock. I know that, but I threw it in here anyway. But these are the only ones I would consider. And St. Mary announced, I think they announced a big takeover today, and their stock is down sharply. So it's slim pickings. It's only these stocks here. And Marathon Pete, MPC, is the only one that really came out in the other screen. So it's the only one I would look at. And I do have a long position in the oil ETF, which, based strictly on technical analysis, I am walking up the down escalator here. But you notice July isn't a strong month. So I'm going to probably close it out if oil hits 80, 83 or higher. But there's a lot, of course, a lot of geopolitics are involved in oil. So oil stocks in July, what comes out number one? Marathon Petroleum, MPC. It is number one in seasonality, number one in July, and number three for relative strength overall. So that's the only one I would consider here. Now this is, I just thought you'd like to see a longer term view. This is quarterly oil from 1880, which really does not tell us very much here, except it's coming off a very oversold condition in 2020 and hasn't broken above into positive territory yet on a rate of change basis. So am I worried about a big sell-off in oil here? Well, let's pull in, if it's okay to talk about fundamentals at a cycles conference, but everybody in the world is trying to get us into sunshine-powered tofu mobiles, and they're trying to shut down fossil fuels by hook or by crook. If you restrict the supply and the production and demand remains constant, price has to go up. But as economies recover, they need more oil. So I think that is what this red line is telling us down here. So I think any mistakes, again, I wouldn't be short oil for very long. And in the period we're in, let me just see if I can remember this by looking at this graph. Yes, I do remember. From here up till about September, oil's been up about 60% of the time. That's not an outstanding percentage, but just the same, from some low point in July. So I'm keeping a small long position in oil. Now, this is monthly oil from the year 1880. And what I like here is looking at the Fibonacci retracement levels. And as we can see, we've popped up. I haven't updated this, but we're up about here right now. But here we have 23.6% of this small range. And we have 50%, which I think is the more important one, of this range. And notice how oil went right through that, came right back, but I don't think you're going much lower than the low 70s. This is what I got that from this graph. So let's look at gold. This is an interesting story because gold was in this rectangle. Now, the Financial Analyst Journal, which is the bastion of all the PhDs, areas we're not allowed to go in, except maybe for Richard. Rectangles are the single most plentiful technical formation. This was in the Financial Analyst Journal. They did this with fuzzy logic. It's an extremely interesting article. They asked which technical formations are most prevalent, and the answer was the rectangle. And which formation was the most profitable? The answer was the rectangle, particularly rectangular lows. In the year, I can't remember, so long ago, I can't remember. Portfolio Management Associates, was with them for about 3 years of some kind of relationship that we had. But anyway, I spotted all these rectangles in the Tokyo market. There were tons of them. And I had to conclude from that, it is a market of stocks, not a stock market. If major stocks in Tokyo are forming lows and they're breaking to the upside, it's got to be a bull market. We bought Toho Titanium and it went up 5 times in value, and it was simply through knowledge of the rectangles. So now that I've established rectangles are important, the black arrow, how far do you expect price to go? Well, up to about 2,400, the height of the rectangle you projected up. Well, it hit it. So right now, I think gold is in no man's land with about 2050 on the downside. That's where gold broke out from. And the old high, which is around 2420, 2450 on the upside. It's in a trading range. And the good news is you've got higher lows here in momentum. And down here, this is relative strength versus a commodity index, not versus stocks. So that's where we are in a trading range. So what do you know to do in a trading range? You refer more to your weekly indicators and to sentiment indicators. And whenever it gets close to the support line, we think about buying. When it gets up close to the resistance line, we short it. When will it break out of there? Well, here's the strong seasonal period. You see this. Now, this goes back to, this is 56 years worth of data. June tends to be a low. We're coming at it, we're going into this period. So we're going into the bullish period. And again, the likelihood of a rise in that month is the red bar, which you can see is almost 60. It's between 55 and 60% in July, August, and September. But look at the return in September. That is on the left scale. That is a return of about 1.4, 1.35%. So we're going into the strong period. I wouldn't want to short oil right here. And this would suggest that it is going to break out of that rectangle, break out of this formation that it's in and go to a new high. But we have not looked yet at the dynamic cycle, and it is pointing down. It indicates a short-term rise up to July 14th, but then another decline. So will it break out and go to the top of that range and break out of it in the month of July? I would think probably not. It's more like it would be August or September. I don't even think it's going to be August. It's just caught, again, it's caught in this range. If you blow this up, and you can see it quite clearly, it's in no person's land, to try and remove the gender from no man's land. And there's the monthly gold cycle. So the dynamic cycle like this is generally stronger than the seasonal cycle. The seasonal cycle is static, it hardly changes, and it's elliptical because it's based on a calendar which is based on the relationship to the Earth and the Sun. And this cycle is based on sine waves. It assumes the cycles are circles, which they're not, but on a longer term basis, it's really not going to matter very much. So the situation is like that of the 1970s, in which rates went well over double digits, equity markets fell, and the economy suffered. Investors sold stocks for less than they paid, but the purchasing power of the remaining funds had declined. So it was a period of very real wealth destruction. Real estate went into a recession forecasted by the 18-year cycle, which made its high last month. So signs of real estate difficulties. I have one of these in every presentation. I limited it to just one. This is the net charge-off rate at banks for the commercial real estate loans. Here's a big high in 1990. I remember I got out of New York just in time. Bank Austria in New York, Lander Bank went broke. And here you have another run up in 2010, a lower high. And now you have it turning up Q4 2023. So these numbers are, that's 6 months ago. So is this the start of something big? Yes, I think it is. Why? Because the 18-year real estate cycle peaked last year, and it is in decline. And there are always going to be pockets. People say to me, well, real estate is going up here or there. Yes, but the buildings that are going up, the existing buildings are increasing in price, but nobody's buying. Prices are too high. And inflation is usually done through government spending, particularly for social programs, but the resulting inflation of the currency hurts who the most? Who owns all the real estate, all the fixed assets? The wealthy people, not the people that the government purports to help. So it is really a social ill. And around here in this area, I'm just outside of Princeton, New Jersey. Well, Princeton real estate is like California real estate was. It really loses its value. And if you read financial history, whenever there is excessive inflation, the excess money created, which is over and above that needed for normal commercial transactions, goes into speculation. So it becomes the planet of the speculators rather than the planet of the apes. And if you look at Amsterdam, when it was in the 1600s, when it was a financial center, or London, or Tokyo, or now New York, although most of the New Yorkers are moving to Florida, the real estate goes way up there because you can make more money by speculating than you can by repairing somebody's air conditioner or by having a retail restaurant or something like that. They're on the wrong end of the inflation game. So these financial centers like Tokyo 89, the prices go out of sight. That's because the people who are doing the trading are making a ton of money and they push everything up. And now, of course, New York has its own problems where if you get carjacked or shot, it's not worth holding on to very valuable real estate. So people are selling and moving down to Florida. In fact, many Wall Street firms have done so. But that is the reason for the inflated. If you look at New York or the financial centers, you'll tend to see a very unreal picture. And I recall living in Houston very briefly in 1980, where we had that huge spike up in oil. And I talked to so many disappointed people who thought that the great increase in the economy was due to some inherent underlying strength that they could take advantage of and participate in. No, it was just a spike up in oil. And I know one architect who did lovely work. Instead of building one house that he had done all his life, he decided, with things going so great, I'll build 8. He wound up in bankruptcy. And my friend's mom leveraged her. She borrowed, took out a second mortgage on her home to buy another home down the street for speculation purposes and wound up in trouble. Now, that's how these things work, but it's happening on a macroeconomic level. And today, there is enough money, as Ian Notley used to say, for any Tom, Dick, or Harry to buy any asset class. So are there any questions, Ron? Can you hear me?
Ron, we can't hear you. You're muted. There you go.
Thank you so much. As I was just saying, thanks, Bill, for the timely key insights. And I was just saying we have plenty of questions. So if you can hear me okay now, I'll kick off with the first one. Great. So the first one is about your composite cycle work, 10, 4, and 1 year. And just as a preamble, could you re-clarify what it is and the signal for this year?
You're asking what?
Well, how would you describe it to people who are looking at it for the first time? And then the specific question sure. I'll follow up with, please.
Yeah. Well, composite cycles, let me just shoot back to the beginning here, are just the average price increase from month to month. And for the Dow, I have the daily prices back to 1885. So this is about 139 years worth of price data. And that's just the average. The red line is the average for every year. And back in the 90s, when Richard Mogi was running the foundation, I said, Richard, is it my imagination, or when you start analyzing any market on this basis, should you start with the annual cycle? And he said, yep, after 8 years of analysis, that's what I found. You start with the annual cycle and you start building on that because it's pretty darned regular. So let me give you an example. If you got a technical buy signal, let's say down here, and a technical buy signal up here, which one would you rely on more? Well, the one down here, because the market, that's in line with the cycle that it bottoms in late October. It's better than going long, let's say up here. You would not want to go short here. You would not want to go short here, and you would not want to go long up here. That's how you put them together. And the 4-year cycle is just the same concept. It's percentage change, but it's over 4 years because there supposedly is an election year cycle. In 1950, it was at 4 or 6. Beryl Dunbar, whom I never heard of before or since, wrote an article for Barron's that said that cycle was about 3.84 years long. And the Rothschilds first noted it, hiring a mathematician to extract that data. You know, that was high technology in those days, to extract that data out of that cycle out of the data. And the 10-year cycle is just the same principle, average percentage change in the Dow Jones Industrials over 10 years, which shows that the most remarkable thing is that years ending in 0 are usually down. I could not get the North American department at ADIA to see that in 2000. I was running the technology portfolio. I fled to like jumping off jumping off the Titanic, I went to external management, and they got clobbered. They were 12%, not 12 basis points, 1,200 basis points, 12% under the technology index after I jumped ship, because they couldn't see this. They didn't want to hear that. And the market did bottom in October 2002, a year ending in October, and that ranked me number one in Timer Digest, just because I knew these cycles. It was, 10 minutes worth of thought. So that's what the cycles represent.
Thank you, Bill. And quite literally, timing is everything. You just heard it there in terms of insights from that period of time. And as a follow-up to that, Bill, there's a question from Sejung on the same composite cycle, 1-4-10, and whether, according to his observation, it looks inverted to price since January. Can you comment?
Yeah, well, that happens at times, yeah.
Any experience as to why it may happen in general or perhaps
Yes.
for this year?
Yes, because there are so many cycles out there, we can't possibly catch them all. And as I always like to say, how do we know there isn't some cycle, let's say in gold, that wiped the pharaoh out of his gold futures 3,000 years ago, but it only happens once every 3,000 years. You can't see that in this data. And this is only from 1885. And Richard Mogi did string all the organized exchanges together. I have the data here, I haven't done a lot. So it goes back to 1650 on a monthly basis. So that's all I can say. But yeah, cycles and inversions are very well known. This is why if a cycle is bottoming, turning up, but you can't confirm that with technical indicators, you probably have a cycle inversion.
Thanks, Bill. And this is a common question, I'm sure, for many cycle professionals out there. When cycles seem like they skip a beat, and as you just highlighted there could be a rogue wave from out of sample data that goes back even further in time. There's a question here from our chairman, Richard, on relative strength. And I'm just going to check the on basically whether you use how you weight relative strength.
Okay, well, first let me say, when you are into portfolio management, you get a benchmark, which you have to outperform. That's the lifeblood. That's what you're measured against. I got switched from engineering school to NYU's graduate School of Commerce as an undergraduate. I got my BS in 3 years. I waived the first year in the Stern School, and I took the second year. And they spent, in that 4 years I was at NYU, undergraduate and graduate, at least 30 minutes on relative strength. I'm still sort of dumbfounded. If you're going to get out and be a fund manager, that's your lifeblood. That's what you're measured by. And yet it's not covered. And I was really not very satisfied with what I had been told about relative strength. So I remember very clearly, it seemed like to me that a stock had to make no new lows from 6 months to 12 months. That would be considered a relative strength base. And I asked this of Richard Bernstein, who was then the head of quantitative analysis at Merrill Lynch in the 90s. And he said, Bill, 6 or 12, statistically, it doesn't make any difference. There's a study that suggests the optimal is 7 months. So in other words, if you have a stock like a Walgreen, which I was short and just got clobbered again today, WBA, look at the relative strength. It looks like an Austrian ski slope. It's going straight down. That's telling you the big institutions are selling. If the relative strength line is going up, they're buying. You don't want to get, you don't want to tease an elephant. You don't want to try and stop a steamroller. You got to go with the relative strength. So what we did is we created an optimization program that looked at relative strength and said which relative strength cycles or which relative strength time periods or look back periods were the most accurate. And that is how we come up with the composite. The benefit is that you can rank all stocks versus each other. The downside of it, Ron, which you'll understand, is if you have a stock that's going straight down and suddenly hooks up and breaks the uptrend, you'll see that immediately visually on a chart, but you won't get it with this RSV value. So you've got to bounce them off.
Very interesting. And just to re-clarify, part of the question from Richard, I believe, was also on how, in your experience, that can be best combined with cycle analysis. So do you front weight one over the other, or is it more discretionary? How do you go about that when the traffic light signals are going off all at once? Cycles, relative strength, and other factors you might be watching.
Well, if I'm getting if a stock, this is a real example. Because they were just before I came on. I saw this on the news. International paper. There was actually discussion as to whether we should add it to the portfolio in ADIA in 1996, I think it was. International paper, and I've got the old Mansfield chart book. The relative strength topped in 1954. You're in the middle of a tech bull market. It's 50 years. I mean, the paper industry is a mature industry. I used to follow it, the value line on Wall Street. Why would you want to buy a paper company in the middle of a technology boom? So number one, if that relative strength line is not going up, then you are fighting with, ADIA. You're fighting with Morgan Stanley, Goldman Sachs. They're selling against your buying, or vice versa. And I wait. If I'm looking at a stock that's been down, I wait for 6 months of no new lows in relative strength. Then if you get a buy signal, I would go with it.
Okay.
But
insightful.
If you get a buy signal and the relative strength is still falling, if it just, as I say to people, look, if it takes 6 months and if it just hit a new low yesterday, then the absolute price may turn up 6 months from now. So why do you want to buy it?
Got it. Going back to don't fight the Fed and don't fight smart money.
Yes.
And then a follow-up question on potential existing and potential prolonged divergences. Time will tell. This is from Sejung. What do you make of the large divergences between the Dow, Russell, and the S&P 500 and Nasdaq? Of course, tech concentration at record extremes. What's your view, and how does that influence your outlook, if at all?
Well, yeah, I look at the relative strength lines. I just wrote a piece last week for the institutions. The S&P 600 has hit a new low in relative strength, and I don't see any upturns. I don't see any upturn in the absolute price cycle, or even if I run a relative strength cycle, I just don't see it turning up. Why? Because, if they don't have the technology, and if rising interest rates hurt small cap stocks, which they usually do, I think rates are going higher, except for these coming 2 months. So to me, the conditions are not conducive to owning S&P 600 stocks or small cap stocks. That's not surprising. And the fact that it's at an extreme, I saw some incredible histogram of the amount of money the big tech stocks are making versus the rest of the S&P 500. And it's just been, we're in a period like no other. When you thought the technology in the 90s was remarkable, it's more remarkable now. There's more and more wealth concentration. So you have to have those stocks that have strong relative strength. And because the relative strength of Apple started to wane in December, January, I haven't owned it up until I rebought it about a month ago. And I also am thinking of buying Google. And I have not, I also already bought Microsoft. So you just look at the relative strength and buy the strongest ones. But these divergences between these big extremes, I mean, would you want to be an S&P 600, a small cap manager now? I mean, that's talking about running up a down escalator. That's it. How do you outperform? You don't. And the Russell, I see these divergences. And the Dow, of course, I don't pay too much attention. It is a price-weighted index with only 30 stocks. So one stock can have a greatly undue influence.
Interesting times, and we were just discussing on day one with our keynote speaker, Peter Ladders. NVIDIA now 50% worth of the year-to-date performance in the S&P 500. So, of course, we've got massive skews. But as you say, that elastic band could continue for longer. The liquidity is there. And I noticed just one last question, Bill, on that. You mentioned the rotation from tech to banking stocks like GS. Do you see that as a sustained move, kind of a new lifeblood of an extended bull market, or more of a short-term thing?
Yeah, I think it's a healthy rotation. I think the tech stocks, I mean, I was given the tech portfolio at ADIA in 91. And it was pretty funny because people were saying, it's overbought in 91. And look how overbought it got by 2000. And you have to be careful with these past comparisons. So I think it's healthy rotation. I think it's good if some banking stocks rally here. I don't see much strength in the healthcare area. I don't see it in base materials. I don't see it in electric utilities. I think that was just a brief rally that was connected to interest rates. So I think it's a healthy rotation. And as you can see, as I said, I was all technology, and I started selling in early April. And now I'm diversifying. I had a great amount of cash, but now I am going back in. I'm in like Grinder. That just popped up on the charts. I was not looking for a dating website. That just happened to be there, and I happen to be involved with another company that streams classical music, so I understand the business model. But yes, I think if it's in the financial stocks, if it's in the industrials, and technology is very broad. My favorite area is still software, because you always need to rewrite software. And hardware, if you get stuck with the wrong piece of hardware, well, then you could be down and out for quite a while. Hewlett Packard used to be a premier company, but they were in the wrong space, and obviously NVIDIA is in the right space. I also bought Broadcom because I think they will benefit from this cycle. And I'm trying to find a bottom in Intel, but I haven't found it yet.
Thank you so much.
So yes, I think it's a rotation.
Thank you so much for your key insights. And I noticed your reference to elections. It'd be great to maybe in the roundtable that we have, that Richard will lead at the end of the session, to hear a little bit more about your view on the 4-year cycle and how that may influence things this year.
Okay.
Thank you, Bill. Thank you very much.
Okay, bye-bye.
And just a brief FSC messaging before following up with our next speaker, Andy Pancholi. Just one moment. Hopefully that should appear on the screens. Yes. So in terms of FSC privileges, continue to explore, especially those of you who are new to our organization. We are part of a greater good mission, which is nonprofit. The work, including this event, is made possible by membership dues and donations. Explore the FSC membership privileges from our event today, but also many other activities that we continue throughout the year. In addition to a free new FSC newsletter that is available on the chat. Click on the link and you can subscribe for free, benefit from that, and learn about much more. And then, of course, continue to be excited about the year ahead, 2024, an online course in cycles to come, masterclass in cycle analysis for crypto, and new edition of our Vulnerable Cycles magazine. And a brief plug for those of you that should already know, we have republished our Dewey book. We're super excited about that, particularly now because there's also interest out in Asia for further distribution of that classic and timeless book. So please read that book for the first time if you haven't already, and reread it some more for additional insights since its republication. Okay, now following on to our next and grand finale speaker. So our 6th speaker in the 6-speaker run, Andy Pancholi, FSC board member, who will be speaking about the power of roadmaps with the open and debated statement, "There are no black swans." And as a brief preamble to Andy, Andrew Pancholi is a renowned market analyst and forecaster who specializes in applying advanced mathematical cycles to predict events in global markets and geopolitics. With a deep understanding of cyclical patterns and human behavior, Pancholi has consistently demonstrated an exceptional ability to anticipate major market movements and global events with remarkable precision. Pancholi's expertise is sought after by some of the world's largest financial institutions, government agencies, and military organizations. He is the creator of a highly acclaimed market timing report. Andy, pleasure always to welcome you back to our FSC Outlook events. How are you?
Thank you, Ron. I'm very well. Nice to see you, and nice to see everybody. So thank you so much for inviting me back to speak. I thought we'd do something slightly different today. And what I'm going to do is show you the power of roadmaps and how we can get an idea of what might be coming up. And we're going to stretch this out over the next few years. What I would say is that I'm going to repeat some information that some of you might have previously seen. but I'm going to add to it. So if you think, oh no, we're showing that slide again, no, hang around, because we're going to take this into the next level, and hopefully you'll find this quite interesting. So let's kick off. Basically, the true facts. So this isn't just about trading and investing. It's about business. It's about your lives and your families, and it's everything you aspire to. So facts are that 45% of all new businesses fail within the first 5 years. And if we talk about trading and investing, and this is the arena that we're kind of in, 95% of retail traders go broke within 6 to 9 months. And this was something I found out more recently. Only 5% of professional portfolio managers actually beat the benchmark for more than 5 years in a row. So it's not really that easy a thing, and it's tough. And we're seeing very low success rates here. So what we're really saying is that, just over half businesses are successful. Only 5% of retail traders are successful, and it's a bit better for the professional hedge fund managers. So the big question is, can we learn from any other professions? Now, airline pilots and flying something, I know quite a few of these guys, and they seem to have pretty much 100% success rate. Most pilots I know have the same number of landings as takeoffs, so that's pretty good, and we'd hope that's the case. So why do they have such high standards and safety records, and what can we learn from them? Well, basically, they have no choice. They have a framework of a series of what we call competencies, pilot competencies, and they are predicated. It's not optional. They have to use these, and they are assessed on these principles. So what can we learn from these? Well, first of all, let me just show you what these competencies are. And there's basically 9 of them, 8 or 9 depending on which system you use. But IATA, the body that rules aviation, governs this. And in here you can see there's all sorts of bits and pieces. And if we look at that onto the next page, these competencies talk about the application of knowledge. There's other things that are directly related to planes: communication, leadership and teamwork, problem solving and decision making, situational awareness and management of information, and workload management. So all those things in red and yellow, whatever you're in, whether you're a trader, a portfolio manager, a business person, these are areas that you could focus on in order to basically become more focused and get better returns and be more profitable. And so the one area I want to bring in tonight is this one: situational awareness and management of information. So basically, what we see here is they perceive and comprehend all relevant information available and anticipate what could happen that may affect the operation. So whilst we're talking about an airplane here, this could be your hedge fund, this could be your investment portfolio, this could be your retirement portfolio. And they anticipate likely threats and events and plan and mitigate appropriately. And they also develop what-if scenarios and plans for contingencies. And they regularly review this stuff. So I know you're thinking, I know what you're thinking. You're thinking you're in the wrong place. Well, where are we going with this? Quite simply, how does this help us? Well, are we aware of what's going on around us? How does it impact our lives, our businesses, our trading and investing? And for example, did you ever hear that phrase? Nobody saw that coming. That was when the pandemic happened. Ukraine, they were never going to, Putin was never going to go into Ukraine. Hamas and Israel, nobody saw that coming. Can we be better prepared? Well, let's take a look at that. In my opinion, we can be, and that's what we're going to focus on now. So this idea of increasing situational awareness using cycles. So human behavior, as far as I'm concerned, and my colleagues here are concerned, moves in set cycles. Events recur in patterns, and therefore, to some extent, they can be forecast. There are no black swans, effectively. Or like Bill said just now, the big cycles, the 3,000-year cycle of the pharaoh getting wiped out, and losing his gold holdings. That's a 3,000-year cycle, a little trickier. So that's what they call the black swans. But some of these things we can really sort of get ahead with. Now, understanding this, in other words, understanding cycles increases our situational awareness. That's the key point. Understanding cycles increases our situational awareness, and this helps us in business, trading, investing, and in life. And so I'm going to bring some bits and pieces, put them together. We're just going to move fairly quickly with these things. But how do we know this? Well, those of you who are familiar with my work, I keep huge matrices of events, and I look for patterns in between them and having done this for 30 years plus now, we find these relationships, and we're able to then project them forward. And then we get an idea of when something might happen. It doesn't mean it's going to happen, but when it might happen. So this is through collating information and looking for patterns. So now I'm going to go through some other bits and pieces. As I say, you might have seen some of this before. Stay with it, because I'm adding a whole new layer that I've never spoken about openly before. Let's head back to 2016 to 2017. And the world really went from globalization to polarization. And what I mean by this is that looking geopolitically, really back here, 2016, 2017, we saw the arrival of different types of leadership. We saw the breakup of globalization and leading to polarization. In Britain, we saw Brexit. So Britain left the European Union, and there were set cycles that came in there. And there was a man, I'm going to mention him now. Some of you will be familiar with a gentleman called Nigel Farage. At the same time, America saw a different type of leadership in President Trump, a very polarizing man, a man who has huge fans and also huge detractors. Now, this is all part of this 82 to 84 year populist movement cycle. And it's about revolution. So really, this area here was a modern day revolution. And if we headed back from this time period, 82 to 84 years, basically 84 years, 1933 saw the emergence of Adolf Hitler. Now, he came out and his leadership sort of picked up momentum because the people of Germany were fed up. Well, what happened here in Britain and in America, the people were fed up of the current status quo. So we saw this rise of Adolf Hitler, and we saw that, and we're going to refer back to this shortly. We saw this because the people of Germany were fed up. They'd seen the Weimar Republic, hyperinflation. They were still paying off reparations from the Great War, the First World War. But we can head back another same cycle to, it's actually 1848. And in January 1848, a gentleman called Karl Marx and his friend Friedrich Engels released the Communist Manifesto. And that was all about workers rising up and breaking free of your chains. Why? Well, by now, historically, the European nations were agrarian economies. People were working in the fields, and they were taken away from the fields and put into sweatshops as the Industrial Revolution came back, and the rich got richer and the poor got poorer, and they were exploited because there was nothing there to look after them. Of course, Marx and Engels recognized this and said, rise up, break free of your chains. And we can take this a further step back to the American Revolution around about 1765, which was the Stamp Act. And so this was quite important because this then really accelerated the road to revolution. Now, this is something new I'm going to talk about in a few minutes. So some of you will have seen this one before, but let's flesh that out. And then the other thing is that there is a 250-year revolution cycle. And basically what we're seeing in this current period, we're 250 years on from American independence. That's why we're seeing all this change in America. And we're also 500 years back from what happened in 1517 on the 31st of October, 1517, Martin Luther. He nailed his 95 Theses to the church door in Wittenberg and started the Protestant Reformation. So the whole idea is that we're 250 years from this current window, we're 500 years, all these cycles are coming together. And if you understand how to forecast with cycles, not only in markets, but also in geopolitics and life, then you know it's the way that multiple cycles come together, that it's when they come together that you see events occur and probabilities increase. So here's the same sort of thing. Here we see the 250-year cycle coming together with three lots of the 82 to 84-year cycle. So that's just a little bit of a backdrop. I'm going to fast track through some of the other bits and pieces because I'm conscious of the fact some of you have not seen this work before. And now let's move to 2018. Now, was the pandemic a black swan event? Well, arguably no. Okay. Certainly our people were forewarned about this because I wrote about this in 2018. And the pandemic really sort of came into play around about late 2019. Well, why? Why was this fairly straightforward to forecast? Because if we go back 100 years, we saw the Spanish influenza pandemic, just the post-war pandemic, and it was called Spanish flu because Spain was the only country that acknowledged its existence. Every other nation did not want people to know that other people, outsiders, to know that their own people were very ill and were losing big elements of the population. You can go back 100 years to 1817 to 1824, which saw the first cholera pandemic. And this literally killed millions across, started in Asia and moved to Europe. So it wiped out a significant part of the Earth's population. Then we can head back another 100 years. We saw the measles pandemic over in North America, and then again the smallpox pandemic in 1618, which wiped out some of the First Nation people, and there was an argument that it had been deliberately introduced. So this was a 100-year cycle. But remember, I've already mentioned this idea of cycles coming together and coinciding to set up an event. Well, the other thing is that we have an 18.6-year cycle. Now, of course, for those of you who are fully familiar, or I don't think anybody's fully familiar with the work that we do here at the Foundation and our legacy from Edward Dewey, he talks very strongly and often about the 18.6-year cycle, which is very, very prolific in all sorts of things. But what we did see was that if we headed back to November 2018, which is 18.6 years back from the outbreak of COVID, we saw SARS. And I remember going through Singapore airport, being the only person in the nice part of the airplane as a passenger there, and there was nobody else there. You go back another 18.6 years and we saw AIDS and HIV, and then we had Hong Kong flu before that. So you can see what really happened here is that the 18.6-year cycle, the shorter cycle, acted as a trigger for the bigger cycle. And on that same note, 18.6 years, if you take that back to the outbreak of COVID, to the absolute month, so we're talking about March 2020, you go back 18 years and 6 months, we had 9/11. Which stocks were decimated during 9/11? Airline stocks. Which stocks were decimated in spring 2020? Airline stocks and aircraft manufacturers. Very, very precise. So you see where we're coming from now, because we're going to project that 18.6 years ahead and be able to put something in the diaries so you can take the long run. Now, so we've looked at how the micro, or not, it's not really a micro cycle, the faster cycle triggered the longer cycle. At the same time, there are a couple of other cycles I want to introduce. Again, we're fast forwarding here. China was 30 years on in 2019 from the Tiananmen Square student uprising. So what we saw here, there's the iconic picture of a student standing in front of a tank, and you can see how, everything just kicked off. Then there was nobody knows how many people were killed in China during that uprising. There are estimates of millions, let alone hundreds of thousands. But you can go back another 30 years, or effectively 60 years, from 2019, we had the Tibetan uprising. So there was this big conflict there. Then we can head back another 60 years, and we saw the Boxer Rebellion. So you can see 120 years on from here, 60 years on from here, 30 years. This is a major cycle confluence. The story does not stop here, because if we bring in that 82 to 84 year cycle with regards to revolution and change, well, we see something pretty interesting. What we see is that the Long March took place as Mao Zedong, the Long March, the rise of communism, 1934 to 1935. Add the 84-year cycle, it takes us to 2019. So now can you see what was happening? There's that. Not only did we have the macro pandemic cycles coinciding with the 18.6-year trigger cycles, China was also aligning with this. So we knew that China had something to do with this or would be involved with it. It coincided with these pandemic cycles. I'm just going to bring in a couple more cycles and then we'll put this all together very shortly. So in 2019, we were on alert for a stock market top. Well, basically, commodity markets see major turns every 90 years. It's just a fact they do. And this also works in the stock market. And so you'll all be familiar with the 1929 crash. The Dow on the 3rd of September 1929 made a high at a price of 386, and it came crashing down, I think it was the 7th of July 1932, to a price of 34, 90% correction. But so people like W.D. Gann forecast this, and here's how they basically did it. It was fairly straightforward. This is the 1929 crash. And if you headed back 90 years, there was a huge sell-off. Again, I think this was another 80% correction. 1837 to 1842 saw this huge sell-off in markets. And this was really due to the expansion of cheap credit in and around, in America. Also, the policies of Andrew Jackson, and basically banking was not overseen very well. There was expansion in real estate around Chicago. They were opening up the Great Lakes, and the idea being to be able to get the grains, wheat and corn out from the prairies, all the way down the St. Lawrence Seaway and out to the world. But it was boom and bust. And 90 years on, we got this thing here, and therefore 2019 to 20, we would have been alert there for a stock market correction. By the way, the sub-cycles work pretty well, and 1884 saw a panic there with gold and silver leaving America. In 1974 saw the OPEC oil crisis. So that was that. Here, by the way, is the 1837 to 42 correction. It was down 74%. So you can see how that worked there. Now, the 90-year cycle was a bit weaker when it came in with the COVID panic, and it came in 2020. So it was actually within 6 weeks of accuracy over 90 years. And you can see that we saw a 34% correction. So you can see how this cycle's working. And I'm showing you these cycles now because we're going to put them together and show you how we're using them right now. So next up, there is another cycle that I want to show you, which is the 100-year cycle. And basically, this is quite an interesting one. Global financial crisis, 2007, 2008. That was a big black swan. I was actually at a significant private event. There were about 40 of us there, Bob Prechter, Jim Rogers. There were some other pretty big names. And somebody said nobody could have seen this coming. And I have to say, this was something I'd done work on. I'd made a presentation the previous year in Cincinnati about this. This 100-year cycle is very precise. 1907 rich man's panic. That's again due to the drying up of credit. Interestingly enough, JP Morgan, there was no Fed Reserve at this point in 1907. I don't think it came until 1911, 1912. JP Morgan was asked by the presidency to come and help sort matters out. Well, which company was one of the top names around in the global financial crisis, rightly or wrongly? JP Morgan. But we can go back another point there, all the way back to 1807 and the Embargo Act, which saw the US stock market go down by 90% because America decided to stay neutral within the Napoleonic Wars on the basis that it would benefit America. They put in a trade embargo saying we're not going to trade with anybody. But of course, that backfired a little bit like how the sanctions and trade wars that Biden's bringing in now with China are going to potentially backfire, especially with electric vehicles, etc. So this is that there are midpoints to this cycle. We haven't got enough time to look at that. But the next one there is going to be 2107. So you can write that down in your will for your grandkids, great-grandkids. Now, so what happened in 2020? Putting this all together, we did see this 100-year cycle come in, right? And we saw the pandemic. We saw the 90-year cycle come in. Cryptocurrencies took off. There's a 300-year cycle from the 1720 South Sea bubble and also the Mississippi boom and bust there. And the grains took off on the 50-year cycle. I think this is a pretty important one. See, this is just a really simple overview of how we put cycles together. And in fact, there's the 50-year cycle in grains. This here was all the way back in 1970. And basically what happened there, it was a triple whammy. We had an exchange rate crisis. Russia had a famine, and there was, I can't remember what the third thing is, but that came in exactly on cue with this timing system here, which we're going to talk about in a minute, where the spike here was looking for a change in trend. But so that's something there. I'm going to stop at that point about markets and so on, and I'm now just going to introduce some bits and pieces to do with war cycles. So as I mentioned, 82 to 84 years is a revolutionary cycle. It's also a war cycle. So just to show you, basically, one of the things we put people on alert from was 2021 was this idea that the world would be going to war. And of course, that did happen with Ukraine. There are so many countries involved in there as a proxy world war. We go back 82 to 84 years. 1939 to 45 saw World War II, and then 82 to 84 years before that was the Crimean War. So one of the things that detractors might say, well, this is all pretty random. The point is, each of these events really involved the major players of the time. This is it. These are the major nations. So the Crimean War, France, Britain, the Ottoman Empire, and Russia. Okay, World War II, everybody. And where are we right now? Pretty much everybody again. So, and then we can just take that one revolution further back, and we saw the American Revolutionary War there. So this is sort of how it works. This is a macro cycle. Now, the trigger cycles here tend to see conflicts in years ending in 1 and 2. So this is a trigger cycle, like we saw with the 18.6 year and the 100-year cycle with the pandemics, etc. Let's start off with 9/11 because everybody's familiar with that. And basically 9/11 led to conflict. But if we go back 10 years before that, we saw 1991 Operation Desert Storm, when after Saddam marched into Kuwait. Then before that, 10 years before that, we saw the Falklands conflict. I'm going to come back to that one in a minute as well. 10 years before that, we saw a series of events, the Middle East and Indo-Pakistani war. And then 10 years before that, we saw 1961 saw the Bay of Pigs failed invasion of Cuba by Kennedy. And then 62 saw the Cuban Missile Crisis. Okay. Then 10 years before that saw the Korean War, and 1941, 10 years before that, saw Pearl Harbor. Really interesting if you understand cycles. We talked about the 60-year cycle when looking at the events in China. 1941 and 2001 are 60 years apart, and they're the only 2 times America has been attacked on its own soil. So what happened in 2021? Well, 2021 basically saw the so in December 1991, the Soviet Union broke up. So the very end of 91, beginning of 92, the 30-year cycle kicked in. And in February the 24th, we saw the activity in Ukraine of Putin moving into Ukraine. So this, you can see how this is working. This is how you can forecast these things, and this is how we did forecast. This is how we did it. Then we used a microcycle to fine tune the potential date. One of the things I've been talking about, it's now popular news, but I really do think America is heading towards some sort of civil war. I don't know. I don't think it's going to be a physical war. We are seeing the deterioration of standards, and we're seeing the polarization of people, red versus blue. Why is that? Well, 39 to 45 was the Second World War. We go back this 82 to 84 year cycle. We see the Civil War. Go back again, we see the War of Independence, and this projects forward to around about Q3 to Q4 of 2027. And this then we published 3-4 years ago, but we're running into this area right now. So this is an outline of cycles. Now I'm going to just bring something else up that I thought was quite interesting that I want to share with you. This is the Foundation Commodity Price Index, which is in the chart book, which I bought a very long time ago. And what here is quite interesting is this is sort of taking the commodity price index back to 1740. It does actually stop here in 2000. But what we can see here is that commodity prices are high and coincide with wars. So we've got the American Revolutionary War at this peak. We got the Napoleonic Wars here at this peak. We got the US Civil War here. We've got the First World War here, and then over here we got Vietnam and bits and pieces. The Second World War there rather. But equally, we saw lows, here at times of revolution. So it's pretty interesting. So what we saw here, for example, is here's 1848. Here's the American Revolution here. The French Revolution here rather, 1789. Here we saw the communist rise of Karl Marx and the revolutions across Europe, and here basically we saw there wasn't so much a revolution here in the late 1800s, but there was sort of lots of polarization going on. Then again, we saw the rise here of discontent rising into the Second World War. But I think this is quite fascinating. What we say is that wars and commodity prices are all aligned. So now we've got a methodology of working and projecting ahead, let's go and have a look and see what airline pilots do. So they identify and manage threats and errors, and they discuss what if scenarios and contingency strategies. Well, it's this latter one that we're interested in terms of situational awareness. So here's the stuff that I want to run through past you today. Right, so there's quite a lot here. This is the good stuff. Some of this you won't have seen before. So what am I seeing right now? I do think wheat prices are going to be heading up soon. And wheat prices align with wars more than any other commodity. So if the wheat prices go racing up, we can expect some definite unrest. 90-year cycle on that. What happened 90 years ago? The Dust Bowl. Okay, that is why this is really important. Also, right now, there is a swing to the right in politics all the way across Europe. We're seeing this in France, Germany, Netherlands, Italy, Hungary. And I think our dear friend and colleague Jake Bernstein mentioned this the other day. So this is saying people have had enough. And I'm going to just link this up to the chart we saw earlier. But all this is going on. And then what we saw... let me just preface this. Everything I look at is objective. It's just a look at cycles, and some of the stuff isn't very nice. I don't pass objective opinion. That we can't. It's just how human behavior plays out. But on the 30th of June, so that's two days on from now, we're going to see the 90-year anniversary of the Night of the Long Knives, where Hitler basically assassinated his peers that he thought were a threat. And basically, then in July. So what happened here is that he seized power effectively. And he accelerated this. He also wiped out, he then, within 3 weeks, surreptitiously wiped out, had Dollfuss assassinated. Now, Dollfuss was the Austrian, Engelbert Dollfuss was the Austrian chancellor who was very much against the rise of the Nazis. So this was kind of a really big deal that was going on. This is the energy. So we're seeing this swing to the right across Europe. Now, I'm not saying we're going to see anything as drastic and as bad as that, but we are seeing huge levels of polarization. And what I want to do here is just, now this is information I've not ever put into the public domain. We talked about an 82 to 84-year cycle. The next thing I've shown you is how a 90-year cycle works. So what we're really saying is that when you have an 82 to 84-year cycle, you need to move forward 6 to 8 years from that point. This is a critical point, probably the most important point of this presentation, where you will see that the revolution turns into something concrete, and it's not always nice. So if we look at this, if we look at Trump and Brexit, we are now 6 to 8 years on. So we're seeing the resurgence of Trump coming back to fight the next election. And over here, there's a gentleman called Nigel Farage who actually instigated Brexit. And he is now running with such popularity in the forthcoming UK elections next week that he is actually destabilizing the traditional British parties of the Conservative Party and the Labour Party. If we go here, back to here, add 6 to 8 years, we see, adding 6 years, the outbreak of the Second World War. And then adding 8 years, we see America joining the Second World War. Basically, if we go back to 1848 and add those same proportions, we now see a huge level of tension over slavery. And this then leads to the Civil War just a few years later in America. Also, what happened in Europe, we saw the Crimean War exactly at this point, just 6 to 8 years on from that. And the same thing happened here. This was the Stamp Act. Once we added the 8 years, we're now in the thick of the revolution running up to 1776. So you can see this is a key point, and I've never seen it written anywhere. It's just from my research how an 84-year revolutionary or war cycle leads into concrete change at 90 years. And that's a very important principle of forecasting. So that's that. 84-year cycle is now a change cycle. Stock markets. So if we look at the 100-year cycle and the 90-year cycle, so go back to, say, 1924 and 1934, the Western stock markets and the American stock markets actually run up. They do head up from here. So I have to concur with Bill, and our forecast with the work I do here also shows 2024 being an up year. But there is also a possibility of a panic, and there is actually an important cycle coming in next week. So I don't know if we're going to get a panic, but we're certainly going to see a change in trend. Next up, 2024 to 2026, half the 82 to 84 year cycle is basically, it's going to see the Falklands issues coming up. Now, you probably don't know too much about this, but it's a protectorate of Britain. It's a bunch of rocks in the South Atlantic off Argentina. Argentina has laid claim to it. Spain has laid claim to it. And everybody wonders why they want this bit of land with a few islands, a few rocks, and a few seals. Well, basically, it's surrounded by oil. That's why people are so interested in it. So that, I think, is really important. I think that's going to rear its head. Next up, people are asking, well, when's the Arab-Israeli conflict going to be over? Well, what we're seeing here is that over in on the 12th of July, 2006, the war started with Hezbollah and Israel. So this is the northern side of Israel. This is Lebanon. And that 18.6 year cycle comes in really in the next few months. And I think that Hezbollah are going to mount an attack on Israel, given what's been happening in the last few months. And by the way, the Hamas-Israeli war was 50 years to the week from the previous war. And that, again, we highlighted. So this basically, things are going to get worse. What are the ramifications for that? Oil. So oil in the Falklands, oil here. Also, between 2026 and 2029, we're going to see the 90-year cycle from a real escalation in problems with Palestine. So this is before the formation of Israel, but this was when Zionism was on the up, and this is where problems really came in. So there are several reasons why we're not going to see an easy, peaceful solution in the Middle East very quickly, in my opinion. Now, we might get a ceasefire, we might get something like that, but it's not going to be over. Moving ahead, the other things that I'm looking at here in America, if we go back 60 years to 1965, we saw, what was it, the Civil Rights Act? Homeland Security comes in. This is all going to tie up with this idea of polarization within America. So we'll come back to in fact, let's cover it now as well. And then in 2027 will be the 60-year anniversary from the assassination of Martin Luther King. So that suggests between 2025 to 2027, which also we're going to see is a rise in sort of unrest within America. And also that, remember the Civil War cycles? Do you see how they align here with separate sort of human behavioral cycles? The other thing in this area, same 1936 to 1929 saw the Spanish Civil War. Maybe Spain is going to be impacted more by the swings in political parties. Maybe that'll have some implications for the euro, because Spain is one of the stronger countries within that alliance. 2027, we've talked about. There's a possibility of secession. I think looking at some of the time cycles for some of the states, they could well secede. What does that mean? I don't think they're going to secede like they did in the past. They're going to be a degree of independence. With civil war as well, there's a lot of prepping going on. I'm talking to people who are prepping, who are hoarding, and so on. That's going to have implications on food prices. Now, this is kind of a really interesting one. I think this is the pivotal point here, and we'll come back to timing this in a moment. But 2029 is going to see the 100-year anniversary from the 1929 crash, and it's also going to see the 90-year anniversary from the outbreak of the Second World War. So I don't think that the next few years are going to be peaceful, and we can already see it now. So this is a pivotal point. It's a double cycle coming together. It's not a nice one, but, you know, let's also put things into perspective. We're all human beings, and, you know, we've lived through the pandemic. We've lived through other traumas and things. You know, this is what goes on around us. And if we're aware of this, remember, this is increasing our situational awareness. We can be well prepared. Then just moving ahead, just to illustrate this, the power of programming, the 50-year cycle, the half 100-year cycle for 1931 probably puts UK into recession. The next pandemic cycle, so remember we talked about 2020, add 18.6 years, viruses then. So if you're speculating and you're fund managing and you're looking for what to go, probably pharma stocks might well be in a bull market as they run into that. The next part of the China sequence is 2049. Just using that cycle set, there are other cycle sets. And if we take 1973, there's a double cycle. The OPEC oil crisis at 100 years. There's going to be a big crisis with whatever the predominant energy is. It might not be oil in 2073, and it's also going to tie up with a 72-year cycle and stock market crashes. So I'm sorry, this is a very, it's at least the stock market will probably head up. So, but there's a lot of stuff to be aware of, and if you're a portfolio manager, there's a lot of opportunities here if you understand how to create these roadmaps. Now, let's just go back to this this notion here of what's happening in 2029 and whether we're going to see a peak or whether we're going to see one before that. One of the things we do here is that we take this super macro stuff and actually pinpoint it down to micro cycles. So we're able to find these. It's like the wheel within the wheel within the wheel. It's like the big cycle with a little cycle with a smaller cycle. And it works in this geopolitical forecasting. This has taken years to program. It works in markets and geopolitics and can forecast very specifically. So with this in mind, here is a monthly chart of the S&P 500. What I want to show you is these peaks here are all aligning with changes in trends. You can see here, here, and here. Most importantly, they're predictive. So we know about these, and we've known about these peaks well in advance. And you can see future peaks coming up all the way through to, I think I've run this to 2032. So this is what we're seeing. You can see there's some future peaks coming in there. And let me just take this a stage further. What we're seeing here is one of the largest peaks that's already evident is for March, April 2030. So that's within 3 months of the 90-year cycle and the 100-year cycle. Is it going to be a high? Is it going to be a low? I don't know. Okay. But what I know is there's going to be a substantial reversal there. The chances are that we might see something occur before then at this point here. But the idea is with this timing cycle, you know when to get in and when to get out. It gives you a better idea, and therefore you can manage your risk more efficiently. So we're here in a seminar presentation. What you don't see here is the understanding of sentiment. Remember, when things are, well, look at sentiment over NVIDIA. Okay, it's just starting to go mad. Everybody's talking about it. So there's a degree of euphoria. Equally, when there's a crash, there's blood on the streets. And Sir John Templeton, the legendary late fund manager, always said, buy when there's blood on the streets. And he bought, after the atom bombings of Hiroshima and Nagasaki, he bought up land in Japan, knowing that it would be usable again in due course. So this idea is that these time cycles, you can write this down, March, April 2030 is a very big turning point in the market, and it's only 6 years away now. Talking about the 18.6-year cycle, many of you know our friends of the foundation, Phil Anderson and Akhil Patel, and they talk about an 18.6-year cycle. Again, the Dewey cycle. That projection there takes us to March 2026. And that there potentially could well be a high in the market using that cycle. And so that's that. Now, home run now, just a couple of opportunities that are coming up. With trading, and we use this sort of stuff, cycles give us situational awareness. And one of the things that we're seeing flagged right now, this is a monthly chart of the euro. We're seeing a pretty big spike here. So the same concept, wherever there's spikes and they're known in advance, there's a potential of a change in trend. So this is a real-time situation developing right now. This month, we're seeing huge cycles coming in the euro. Well, if we look at this, it's been sideways for over a year. So how do we delve deep into this? We look at what the smart money's doing. The commitment of traders data, Jake Bernstein, our dear friend, talked about this 2 days ago. He did a fantastic job. Now, they say markets can't be forecast. And I remember that Larry Williams very clearly writing maybe 20, 30 years ago that actually they can be forecast because the markets are driven by the smart money, what are called the commercials. Now, what we see here is with regards to the euro, the commercials are selling less and less and are buying more and more. And they are now approaching net long. So this suggests that the euro might well be in for a reasonable move up right now. And of course, the opposite of that is that if we look at the dollar index, look at that. Suddenly there's a massive jump in selling there. It's a little bit fine, a massive jump in selling there. So that's looking bearish. And of course, the dollar, the euro is a significant proportion of the dollar index. So this is the way we can use timing and cycles to benefit and get the odds on our side. So, oh, yes, and taking this down another level, we have this information where we can see that the euro is potentially long. We've got a weekly cycle coming in this next week as well, and then another one 2 or 3 months down the road. That suggests there's going to be a 2 or 3 month rally in the euro, and a daily cycle there around about the end of the first week to second week of July. So this now enables us to manage risk very effectively because we've got some key points. We're still going to have to, draw the lines in, use whatever technical stuff you use and fundamentals, and get your risk management in. But what this tells us is that we can use mathematics and time cycles to effectively manage risk and find opportunities by putting everything together. So I think I've got 40 minutes. There we go, 39 minutes. Human behavior does move in set cycles. Events recur in patterns, and therefore they can, to a degree, be forecast. And also, it's pretty clear to say that there are no black swans. So, Rob, over to you. Ron, I think you're muted.
Okay, one last time. Mike, okay? Everyone can hear me?
Yes.
Thank you, Andy, for a whirlwind presentation of key insights and dates. And as I was just showing, but the sound wasn't working there, pen by my side, and I'm literally taking down some of those major dates for the future. And I think quite a few of us are doing the same. A few questions before we segue into our grand finale FSC roundtable that'll be headed up by Chairman Dr. Richard Smith. And there's quite a few questions on the chat, so I'm going to try and get to as many as possible in the time available. The first thing is from Sejong asking your point at the very beginning on the on basically pandemic and virus cycles, that heavy subject that we don't really like to talk about, but of course it's important for many reasons. He wants to know, what's your view about the latest emergence of the bird flu now, perhaps a quarter cycle to the 18.6 one that you were sharing?
Yeah, okay, so that's a really good question. So what I've done is just showing you an overview. There are many cycle and sub-cycle sets that we have to put together to get really accurate forecasting. So it could well be that subset there. But what I would do is I would make a note of every time there's been a peak in bird flu activity, and then you'll find that you've got to do like for like, and that's what the key is to forecasting. You've got to put it into context. You can't suddenly say, well, this is a bovine pandemic, this is a bird flu pandemic, because they don't work. But what you'll find is that they will mix together, and at some point they will cross and align, and on that basis, that's where you'll see the events occurring, and also you can project forward from that point as well.
So hopefully time will tell, and perhaps later on down the timeline in terms of that type of event risk. The follow-up question is on more about the timing of your big cycles, and I'm sure there's a variation to this answer based upon which cycles, but essentially Jason's asking, generally speaking, how much variance do you typically see in these cycles? He didn't specifically say which ones, but if you were to give an educational insight, what would you share on variance?
Okay, so I'm not sure how to answer that because that's quite a complex question, but what I will tell you is that most of the proportions we looked at, with the exception of the 150-year cycle, are derivations of the 18 to 18.6 year cycle. So 90 years is effectively 5 18-year cycles. So we see that. And then there's a whole host of sub-cycles and other techniques as well, whereby we can look at Fibonacci proportions between events in time, just like we use Fibonacci in time on markets as well. It's the same concept. And
then closer to home, well, depending on where everyone is in the world, but let's say US and UK is a case in point. Question from Bliss2B. What are your thoughts on how Trump Brexit piece will play out over the coming years? Of course, we have the US elections this year and UK just coming up.
I think they're going to lead to a rise of polarization furthermore. I think it's going to be different in both countries. I think America, I've made the case very clearly. I think it's going to be very polarizing. Regardless of who's at the helm, there is now a lack of respect for authority. There is a perceived lack of integrity in the election system. I don't know if it's, being tampered with or not. Nobody knows. And that's the whole point, is that this is what's going to be. And then the other really important thing is people will now only watch what they want to watch. So they won't get a balanced view. I don't know if there ever was a balanced view, but so whatever it is, whatever your preference, your choice, you're going to watch that media. And that's what's going to lead to the tension that we talk about civil war here. I don't for a minute really think we're going to see people shoot, outright war, but we are going to see tension between communities. I think that's what's going to happen. I really think that's what's going to happen. So I think it's all going to polarize, and that's it. In America, the challenge with Britain is what happens in America tends to come to Britain soon. At some point. So the thing is that if we go back over the last 20, 30 years, we've lived a pretty nice life, most of us in the West, and we've seen gains in stock markets and so on. So we do have to go through a troublesome period, and whilst we're for example, we look at what's going on in Ukraine and so on, and there's two sides to that argument as well. If you look at the history behind that, we're not directly impacted by that because nobody's bombing us here at home. But I honestly do think we are heading into troubled times. And that, I think, is the Brexit and the Trump situation, and not just Trump, Biden, and whoever else is living. Is going to precipitate a bit of a breakdown of unity and harmony. I think that's it.
Thank you, Andy. And just to preface on the geopolitical situation that you've highlighted, this year alone, 40 elections around the world, most of them in emerging markets, and as you mentioned, a shift onto the right side of politics. And I just saw recently a headline: traders stunned by election surprises recently from Mexico City to Mumbai. And there's been a non-consensus reaction to what's been happening recently. So it'd be really interesting to see what happens UK in the coming time, US to follow, and many other elections, as well as all the other event risk cycles that you mentioned. And on that note, we want to continue with the momentum, invite the rest of our FSC team, board members. Richard, over to you for the roundtable.
Great. Thank you, Ron. Great job hosting. And thank you so much for great presentations, everybody. So just while I have Jake and Andy here, I had to ask Jake, I saw you were giving some other talks this week, and you were asking if we were likely to see nuclear war. Curious how your and Andy's geopolitical and cycles overlap. Any thoughts?
Was that for me, Richard?
Yeah, that was for you, Jake. Is there going to be nuclear war?
I don't think there's going to be a nuclear war, but I do believe some crazy person in Europe will be forced to use a tactical nuclear weapon. So
are you basically seeing similar cycles to what Andy's seeing in terms of conflict and scarcity, et cetera?
Yes, I am. I am seeing some definite cycles in that respect, especially regarding the price of wheat and the price of cotton, which was in Dewey's book. There's a very close relationship between the price of cotton and actual ground war.
Interesting. So I'm glad you mentioned that, because I do want to bring up Dewey's book here. Of course, we just republished this. It's available everywhere. And there's, there are amazing, I can't quite figure out why his work and the work of the foundation didn't really get the recognition and carry on, when it had such a incredible, auspicious beginning. Here's another book I was reading recently, Sunspots and Their Effects by Harlan Stetson. This guy was like head of one of the labs at MIT back in the 30s, right? Charles Greeley Abbott was the secretary of the Smithsonian, was doing all this research into climate and sunspots. Raymond Wheeler, climate, war, etc. All these things that seem so relevant and topical to our work that just aren't really talked about that much anymore. Any ideas why that is and how we can help reach a wider audience?
I'm
Both
not
of you, anyone, Andy, Jake.
I'm not a conspiracy theorist, but I do believe that the powers that be that use cycles wanted to keep it quiet rather than distribute it to the public.
You know, I on that note, we recently had the passing of Jim Simons, right, of Renaissance Capital. I think he made something like 60% a year on average in his main fund that was only open to employees. But I think a lot of his strategies, you know, he could never explain why he did what he did. It was just whatever patterns he saw. Whatever patterns the computers picked up. So I do, you know, I think in some ways that validates your point, Jake, that, hey, if you're making a ton of money off this, you know, why talk about it? But meanwhile, there was Dewey, there was, you know, Stetson, there was Ellsworth Huntington, Charles Greeley Abbott. Andy, what are your thoughts?
My thoughts are, first of all, it's not very sexy, a lot of this work, unless you really get into it. People these days, because as I mentioned in the presentation, we've had a pretty good 20, 30 years, you know, and people are more interested in what's happening on FaceTube or whatever you want to call it.
FaceTube, I haven't heard that before. That's
also,
good,
you know, also it is being used by people who are quite happy to use it and to have it remain in the background. There is no doubt about that. I know because I'm speaking to some consulting to some quite interesting people and agencies that are using this stuff. Yeah. So, and then if we want to be a bit more conspiratorial, then, you know, it's kind of like if you want to control things, you know, it's if you know the cycles and they don't, then you're winning. Exactly. That was the whole point of the roadmap that I've shown. This is what lies ahead, right? Who else knows what lies ahead? Has anybody else thought about this? Sure, some of the guys here, you know, ladies, gentlemen, and anybody here, we think about this, but very few people do, and I think that's the whole thing. And like, you know, whichever book or religion you subscribe to, there is no new thing under the sun, and that's it. But it's not very exciting for most people. I mean, it's pretty exciting for us because we work with it, we make discoveries, and we make a living from it, and, you know, we do quite well from it. So I think it's fascinating. But human behavior is just that's it. It's not open to this sort of stuff, generally speaking, apart from everybody here that's at the foundation.
I'm interested, Andy, in, you know, given all of the scenarios that you've put forward as something we should be considering, how is it impacting your own decision making in your life? What are you doing? How are you using this information in your life?
Well, there's several
with
ways.
your family.
Yeah. So, you know, one of the things we're considering is where we should be living, you know, and where would be a better place to be, where would be the best place to be. You know, how to, you know, doing a little bit of prepping maybe. And then operationally, you know, there are opportunities in trading and investing here. One of the ones I'm looking at right now is wheat. Wheat sees some very big cycles coming in the next 2-3 weeks. And the other side of it is some of these cycles are suggesting there's a significant turning point coming up in the S&P 500 in the next 10 days. So with that knowledge, staying out of that market, but looking to see if we can manage risk with grains and so on, and the euro. So those are sort of some direct sort of trading opportunities. Also, it's there to make ourselves, we make ourselves available to those who want to speak sensibly about it and those who want to learn from this. I know firsthand that security forces are interested in this sort of information. Law enforcement's interested in this sort of stuff. Politicians aren't interested in this because they're only interested in the next 4 years. That's all. But those who have to clear up the mess after the politicians are. And I think that's where this gets really interesting. So if you can work with people that want this information and that can act on it, that's great.
Comment, if I may.
Please, Jake.
So, by the way, I am a board member, in case somebody forgot.
Yes, put that board member label on Jake.
I will say this. I have every piece of real estate that I bought and sold in my life was based on the cycle that I found in Dewey's book, the 17 to 19-year cycle. And I've never lost on real estate with that cycle. And so it's been very helpful to me in all of my work, including my trading, which is influenced every day by cycles. People just don't want to recognize that there is a future and that the future is repeatable. And so if you're looking at a situation where you know something bad going to happen, you want to be in a state of denial and not look in that mirror and see what's really happening. So I think that cycles, which give a powerful ability to forecast the future, are also scary in what they may be predicting. As you can see from Andy's excellent presentation, a lot of scary stuff in the future, and nobody wants to look at it, let alone act on it. So I apologize for that statement.
No, appreciate it, Jake. Personally, I think another part of the reason that cycles don't get recognition or don't get talked about much is because a lot of our kind of professional culture today is based on this idea that, people are in control and what Jerome Powell says matters. And, he actually can control the economy, which is preposterous, right? But yet that idea of so much of our media and so much of our professional world that, we're the ones who are pulling the switches and levers is a very powerful incentive in our media driven world today, I think.
True.
And the cycles kind of, contradict that. I mean, look at the financial world, right? Everybody's out there. You turn on the news it's unbelievable how much opinion is going on and everybody's saying why this is happening or why that's happening. And yet, it's like, what about cycles? I want to talk about cycles. Oh, let's not have that guy back next time, because that doesn't sell advertising.
And the real truth is that, Wall Street just wants the market up one way, and that they're not here to look after your pensions. They're not here to I'm going to say this out aloud.
Yeah.
They're there to make money for the firms they work for. And I think that's a fair statement because, those of you who are here listening and doing that, know that your bonuses are based on what you sell.
It's a fair statement, and that's the way the incentives work, right?
Yeah, exactly. And, I've been part of this as well. But the point is that, if you do know there's a downturn coming, that's not going to help your bonuses. If you're having to sell to people, I mean, if you're trading the market and you have the long short option, which we have historically had, then it's nice. It's an opportunity. But that's the whole thing. And the truth is, I mean, I was asked about this many years ago, and I wrote a piece in a mainstream Sunday newspaper here. Was that you have free will. Right. And if your task is to cross a minefield, would you rather do it with a map of the minefield or without a map of the minefield? And even if you had that map, you still have further free will to step on where the mines are. Well, the cycles provide you with a map of the minefield. How you choose to circumnavigate that minefield is up to you.
Yeah. And I think that brings me to kind of the last point that I want to touch on here. Cycles, they can be a little scary, right? And a lot of what we've talked about, a lot of what is the foundation has been publishing, for the past couple of years, anticipates conflict and declines, et cetera. And yet, we also think, by and large, the market's likely to go up for another year or two, right? So even right now, there's a lot of noise in the cycles community about a possible correction. Andy, you're talking about a big signal in 10 days. how do we manage that kind of cycles suggest this might happen versus, here's the kind of reality, the trends that have been happening in our world, that we have to, not pretend are going to suddenly reverse just because a cycle says they will. So any advice for our audience to integrate this information, in a constructive way that's not like go out and sell the farm and dig your bunker and, get ready for nuclear war?
Sure. Well, Bill hit it on the head. He said there are no certainties, and what I'm saying, is, for example, the S&P has hit a significant price objective, and there is a time cycle. It doesn't mean there's going to be a crash. It just means that right now the odds are not on our side. We can't manage the risk. And personally, I don't know which way it's going right now. It's hit an objective. It could sell off. It could just pull back a little bit. There's a lot of money on the sidelines. But sorry, yes, go ahead.
Place to get long.
Yeah,
Exactly. The odds are against you.
Let me say this. I think stocks are going much higher before they top. However, who was it that said millionaires don't use cycles, billionaires do? So that's my closing comment.
JP Morgan, I think.
I think it was JP Morgan, that's right. But I think what people have to do is find those particular cycles that they're comfortable with, whether it's a seasonal, whether it's a 6-year cycle or a 3-year cycle or whatever, and make decisions based on those cycles, because there's so much work out there, so many cycles out there, you go crazy trying to figure them all out. Find the one that gives you comfort and profits and be consistent with that.
I love, Andy, what you were saying about situational awareness, that the cycles really do give us situational awareness. It doesn't mean it's going to happen, but it does mean that these are things that you need to be paying attention to. So I would say, at this moment in the markets right now, there's a need to be more vigilant because of some of these, price targets that have been reached, some of these cycles that are turning, some of these, events that are on the horizon. And it definitely, that is certainly how I use cycles. I don't just make decisions exclusively by cycles, but I absolutely use them for situational awareness, and I wouldn't be without them. So meanwhile, I do think it's very interesting to think about, where these cycles come from, what exogenous forces might we not be completely aware of that could be correlated to some of these cycles. All really interesting areas of research, and we are the foundation for the study of cycles. And we are working, that's why we're here, to bring this knowledge to a wider audience, to connect with other people that want to do this research as well, and to get this information out to more people, and really to pick up, I think, some of the threads that Dewey and the early leaders of the foundation really set out to develop, and which, as far as I can tell, are still there for the taking. So if you aren't a member of the foundation yet, please join us. You can sign up for our newsletter for free, hopefully become a member. You get access to our basic technology. And if you want to do some of the intraday cycles analysis that I was showing in my presentation, you can join us at the Analyst Pro level. But it's great to be with everybody. Ron, I don't know if you have any comments you want to chime in on here, but feel free.
Happy to share comments from our audience that are basically in agreement. Just a brief insight from one in particular, which goes back to the point you made about that knowledge of future and whether people really want to be aware of it or not. I think Andy echoed that as well. So thank you all for everyone sharing those insights in the chat just now, a philosophical but important nuance of cycles and how we can integrate it within our life. It's been an honor and a pleasure, Richard. Thank you.
I want to just share this image that I posted yesterday. I don't know if you saw it, but sorry about the weird screen, but did you guys see this? I don't know if you can see it on the screen now. Hopefully Dan's putting it up. Can you see this image now?
Yes,
yeah.
So this was, I said to DALL-E, right? OpenAI's image generator. I said, make me an image that shows that expresses the statement, man is a puppet on a string. And this is what came out. And I've really been taken with this image because I think that it definitely shows, like, forces, puppets on a string, but it also shows a person, I think, with situational awareness, if we could say, about the existence of cycles and like a cooperation with cycles. And I think that's one of the things that's really emerging for me as the foundation comes back to life. This idea of how we can be more aware of cycles, but not in a threatening way, in a cooperative way, in a situational awareness way. How can we work with the cycles? Even within the foundation, I think sometimes we can get too focused on, oh, let's predict this cycle and that cycle and let's make money off of it, et cetera. But I think our mission is really a bigger mission of how do we, cultivate and curate more knowledge and awareness of cycles, and then learn to cooperate with them more. What do you guys think?
Absolutely, Richard.
So let me get back to stopping that share. Sorry for there we go. Thanks, Dan.
Yeah, I think you're absolutely right. We're here to educate, and when the time is right, the teacher arrives, I guess, is one of the things. So, and I don't mean that from any arrogant viewpoint. I just mean when people are ready to hear and investigate something, they will arrive. So, and I think that's really the key to this, is that we can only keep doing our work and share whatever we can share that's appropriate. And if it interests you, then I think perhaps the real truth of the pudding is just look at what we've achieved since we restarted the foundation with you at the helm, Richard, where you've, very kindly taken a lot on and put a lot of personal money into this. We already have tens of thousands of followers, right? All in the last 4 years we've been doing this.
Yeah, 3 to 4 years.
Yeah. So there are people out there. And the other thing, which may be a little bit tongue in cheek, but I no longer debate the validity of cycles unless somebody has definitely explored them. But honestly, if you tell me cycles don't work, I don't care. Just go away, because I'm going to take money off you. That's it.
All right.
Go and read about it yourself. And
Well,
that's it. So
that was good situational awareness, Andy.
thanks, Jake.
All right. Well, thank you so much, gentlemen. It's been great working with you as always. And thank you to our audience. Please spread the word and join the foundation and help us bring this work to a wider audience. Really appreciate it. It's been a great show. Thank you so much, everybody. And we'll see you again in 6 months.
All the best, everyone.
Bye.
Thank you. Bye-bye.